Hi everybody, this is AJ speaking. This is a review of the September 2025 CPI release, Consumer Price Index release for the month of August. You see in front of you what was reported in mainstream media. I just picked here rather randomly the Wall Street Journal. You see here the headline number. Headline CPI rose to 2.9% in the 12 months through August. And this was in line with expectation. Just more specifically, what they mean is the index of the CPI for August rose by 2.9% compared to the index in August 2024. And then they talk about this is the fastest rate since the start of 2025. And it's a slight acceleration on the 2.7% seen in June and July. A widely observed component of the CPI is the core CPI. And as they write here, excludes volatile food and energy cost. And that held steady at 3.1%. So what I want to do in this video to dive into the details, what is driving the CPI, and to see whether we can draw some conclusions from there. So this table shows you the CPI components for both July and August. So for the most recently reported months here on the right, August, and then on the left, July. And what you see up here as labeled all items aggregate, that is the headline CPI number. So that one came in at 2.9% as we just discussed for August, and is slightly up on the 2.7% from last month's July. And then as the Wall Street Journal reported, the core CPI, that's the second item here, and that's labeled as all items less food and energy, was 3.1% in July and was yet again in August 3.1%, so no change there. And then there's a third aggregate, but is significantly less discussed in mainstream media, just services less energy. That was also constant month over month, or should be more specific, the year-over-year change rate of 3.6% was constant month over month. The next, in terms of the color coding that you see, red means it's above the 2% target of the Fed, and gray means it's below 2% or slightly deflationary, means negative. If it's this teal color, it means it's highly deflationary, defined as more than 2% negative. Next, these numbers, they correspond to the percent weighting of each item. So up here, these items, the top three are the aggregates, so they don't have any weighting. They just show you the total for that bucket. But then here we start, and here the numbers here, number 1, number 2, number 3, show you the items in the CPI basket ordered by weighting. In other words, ordered by importance. And the way the CPI is calculated is quite straightforward. What happens is that each index change for each item is multiplied with the respective weighting, and then the resulting amounts are being simply summed up, and that gives you the headline CPI. Important to note that when you look at these weightings, there are some, let's call it heavy hitters, that make a huge difference, but then very quickly these items drop off quite significantly in terms of relative contribution, and therefore typically don't represent a major driver unless there's an extreme outlier. And earlier this year, highly popular and also widely discussed was the egg price. The egg price has a very low weighting, but because it was absurdly high in the 70% range and higher, it still had a meaningful impact on the CPI despite the very low rating. So it's something to keep in mind. So when we scroll down here and look at the various items, at least under these top 100 products, there is no extreme outlier at the moment. There are some items with very high year-over-year increases in index, i.e. inflation, but there are no crazy items. So let's maybe go through the top items, and I'm using this kind of ruler. So the first item was the largest weighting. That's what's called owner's equivalent rent of primary residence. So it's basically a statistical value that tries to reflect the cost of housing. That significant driver is down slightly month over month. So last month it contributed meaningfully to the inflation, was at 4.1%. It's still high. It's still up year over year in August at 4.0%, but there's a slight easing at least observable. So the next biggest item is food at home. That has a weighting of nearly 8%. And by the way, these weightings change quite often, but only by small margins. That's why you see The weighting here is slightly different. So in August, the weighting decreased to 7.98%. So the weighting change really has no meaningful effect, but you can see that the year-on-year inflation rate increased quite significantly for food at home from 2.2% to 2.7%. The next item with 7.45% is a rent of primary residence. That's another type of housing cost proxy. I will not go into detail in this presentation to explain the difference because frankly it's not that important. However, what is important is the trend, but here this item, I mean, it's still quite high, 3.5% year-over-year increase in July, but at least we see some stabilization here. It did not increase further, but at the same time, it's not dropping meaningfully. The issue with these very heavy hitter items with a very high weighting related to housing is that measuring the cost of housing is actually very, very complicated once you get into the details. And unfortunately, even though I think the methodology is quite sophisticated, there are a number of weaknesses, and the reason why there are weaknesses is because these issues are very difficult to solve. One big resulting issue with these housing numbers is that there's a significant lag effect, and some of the data that feeds into it is survey-based, and survey-based is always a little bit tricky. Next, we move to the fourth heaviest item, that is new vehicle sales. They have a weighting of 4.3%. And in July, their year-on-year increase was very low, just 0.4% increase, so actually below the 2% the Fed is targeting. But in August, we saw a slight uptick to 0.7%. Next item, number 5, household furnishings and supplies. Weighting was of 3.4%, increased from 2.4% to 2.8% inflation. Then we get to number 6, is energy services, weighting 3.3%. Here, inflation also increased from still very high 7.2% to 7.7% in August. And next, we come to the item that is concerning to me as an investor, and that is gas prices. So gas prices have a weighting of just under 3%, and that makes it the 7th largest item, so quite meaningful. And what we can observe is that thanks to still low oil prices compared to last year, in July, gas prices provide a significant deflation, let's call it boost. By boost, I mean over inflation lowering effect. So it was positive from the current perspective, because right now we're still dealing with elevated inflation. So this deflationary effect from gas is quite welcome. But we can see this effect is significantly easing off in August, where that deflationary contribution of gas was only 6.6. And the reason why the deflation effect of gas prices is easing so much, you can see here. So this chart shows you just the oil price development. So at the moment, oil price is at low 60s, $63. And but for the inflation index, what's relevant is what happened year over year. And when you look down here, and you can see what's going to happen. Down here, so this is wait a second. So here we have August 12th, 2024. Oil price already dropped significantly. You can see that in July we were at this kind of peak, and oil price was in the 80s for a number of for a long time in that month, and that spiked gas prices. This created a quite low year-over-year comparison, and that's why we see. That's why we saw in July a significant deflationary effect, because we went basically from call it low $80 oil price range to low 60, so a massive decrease. But the problem is, and this is what you already see in August, that in August of last year there was already quite a bit of a drop, and you can see now we dropped in August of last year to, let's call it, the mid 70s. So and you can see what happens next. So in next month, in September, we'll be fully in this, let's call it local trough of last year in September, where oil price dropped to, let's call it around the 70s or high 60s. And therefore, we basically can already say with very high certainty that the deflation offset we got from gas prices will significantly reduce in the next print. And that's why I said earlier this is a concerning item, because number one, it's quite heavy, and the deflation offset for that reason, number one, it's quite has a very high weighting, and number two, the deflation level was quite high. So when you combine the two, the deflationary offset it provided to the overall inflation index was quite material, but we can see it's dropping off quite quickly. So we lost about, what is the delta, 290 basis points just 1 month to the next. And as you just saw in the oil price chart, there was in September of last year quite a substantial drop. That means we likely see a similar months over months reduction of the year-over-year deflation offset, which likely creates further pressure relative to further reductions in overall inflation prices, inflation index. So what's the big picture? The big picture is that the market fully priced in a rate cut next week. This close to before a rate cut, before FOMC meeting, the market was never off. So I think we still get a rate cut, but because of this development and other things, I think we will not get more than one rate cut. But the market at the moment is pricing in on a probability weighted basis, slightly more than one rate cut. There is another rate cut expected for the subsequent meeting. But as you saw, if this trend continues, we lose these important offsets and other inflation elements remain sticky. We might see another period until, or I should say, we might see another period of prolonged steady rate levels. And there's right now not priced in. Right now, there's a clear expectation in the market of several rate cuts. Next, we look at item number 8, limited service meals and snacks. In that item, we saw a slight easing to 3.2% from 3.3% in July. Next item is item number 9, motor vehicle insurance. That item came down quite meaningfully from 5.3% to 4.7%. Motor vehicle insurance was for a number of months a big problem for the inflation print. But the underlying driver was not related to monetary policy. It was related to very high insurance claims in the auto insurance sector. Auto insurers were losing money left and right, and so they had to hike premiums that already started last year. And the primary driver of the premium hike was that there was a significant increase in accidents caused by inattentive drivers, caused by the using phone while driving epidemic. Next, we look at item number 10. This is electricity, also significant weighting at almost 2.5%. Electricity inflation keeps going up, increased in August to 6.2% year over year from 5.5%. And I'd like to point out, despite reducing oil prices, and the driver is obvious, data centers for AI just soak up all the electrons that are available. And as I discussed in prior months, I expect this trend to continue, because at present it appears that electricity production increases are unlikely to sufficiently outpace electricity demand growth for an easing in prices. Next, we look at item 11, full service meals and snacks. This item saw an increase to 4.6% compared to July's year-over-year rate of 4.4%. Next item, 12, used cars and trucks, weighting of 2.42%. That weighting increased to 2.44%, not a big needle mover, just something I want to point out. And here we see a further increase in inflation pressure. And you can see in August, year-over-year used vehicle prices were up 6%. And that is a significant increase over July, where we saw an increase of 4.8% year-over-year. So the next three items 13, 14, and 15, they all saw year-over-year increases. So if we go from 13, or we start from 13, it's other food at home, increase from 1.2% to 1.5%. Physicians services increased from 3.1% to 3.5%. And then other foods increased from 1% to 1.5%. 1.2%, so 1 to 1.2. College tuition fees, the inflation rate is down month over month the year-over-year changes down month-over-month from 2.4% in July to 2.2%. So that the next four items are the last few items that we discussed specifically, because then we drop to items that all have less than 1% contribution. And so these four items are items 17, 18, 19, and 20. And 17 is wireless telephone services. Here we can see a significant increase in deflation, so that's helpful. And then item 18, other lodging away from home, including hotels and motels. There was a significant deflation offset that we received from that item, but that one is also easing, and at least from negative 4.8% in July to 3.7% in August. Then when we look at 19, that's cereals and bakery products. Here we saw a slight increase in inflation, but at 1.1% it's still low. And then we get to fresh fruits and vegetables. Here we saw a quite substantial increase from 0.3% inflation in July to 2.3% year-over-year inflation in August. And when we look down at the rest, so the big picture is that there is still a lot of inflationary pressure, especially amongst discretionary items. Non-discretionary items. So in items specifically where the consumer doesn't really have a choice, so necessities for daily life. And worryingly, as I pointed out earlier, some of the big deflation offsets that we received are soon going to run out unless we see a further decrease in oil price. However, oil prices have been sticky in the, let's call it, low 60s, mid 60s for quite some time. And near term, it appears unlikely oil price drops into the $50 range unless we see more recession signs coming either out of China or the United States. Or it doesn't have to be a recession, just a meaningful economic slowdown. At the moment, this doesn't appear to be the case, but something, of course, very important to monitor. So big picture where we are. So at the moment, I think market is highly focused on rate cuts. But as I warned it in another video, historically, as conditions change, this can quickly then flip the narrative to worries about the economy. So that's the end of my inflation review. I hope that was helpful. Thank you very much for listening. See you next one. Bye.